Oil and US Treasury Yields. Very important subject, isn't it? We have extraordinary set of Treasury Yields. And what's exactly happening in the international market? Because US Treasury has got wider impact in the stock, again, bond. And we have to look at how it is going to have overall global investment inflows for US and rest of the world. Oil policies are vital. Quite oil supply to India, there is a disruption planned. US 10-year Treasury and rest of the bond yields, including German. Reflation trade, it's another aspect we need to understand. And the prices, oil policies is one aspect. What will be the reflection in terms of oil prices in today's context, and what will be the way forward? Oil policies to start with. The oil production curbs by OPEC Plus are set to tighten the market in the first quarter, and also thanks to Saudi Arabia's additional 1 million barrels per day production cut by beyond its quota in the OPEC Plus pact in February and next. So while Saudi Arabia are cutting extra barrels to support the market and prices in February and March, Russia, the leader of the non-OPEC group in the OPEC Plus pact, was allowed to boost production by 65,000 barrels in each of these 2 months. So OPEC as well as non-OPEC you have. As the next month, Joint Ministerial Monitoring Committee scheduled for March 3rd to decide the production levels from April onwards is fast approaching. Speculation is said to increase about Saudi and Russian views about a further easing of the OPEC Plus cuts. That's important. Now, neither the market nor the two countries have forgotten last March debacle when Russia and Saudi Arabia disagreed on how to tackle the crashing demand at the start of the pandemic and broke up the OPEC Plus pact for a month. Consequence was wild. After the Texas freeze, the oil market will now be increasingly turn its focus now to March OPEC Plus meeting as the call for more crude oil is rising. The markets are recovering slowly. There is a pent-up demand. Brent oil passed 65 a barrel as worsening US energy crisis took almost 40% of the nation's crude production. Adding to the bullishness, the American Petroleum Ministers reported almost 6 million barrels drop in US crude stockpiles. Saudi Arabia's energy minister, meanwhile, urged the fellow members of the OPEC Plus oil alliance to remain cautious as they prepare to consider further output increases. So more important is further output consideration. Iraq, another OPEC Plus member that often eager to boost the taps, said that last week the group may choose to keep production steady at the forthcoming gathering. Russia and the UAE, which have passed for increase at the recent meetings, have yet to take their preferences, what they're going to do. Are they going to increase or decrease? Prince Abdulaziz bin Salman's warning indicates that another debate could ensure when the Organization of Petroleum Exporting Countries and its allies meet on March 4th. The meeting is so crucial. When it comes to Kuwait oil supply to India, at a meeting with Indian refineries this month, KPC officials said the state-run company's next oil supply contracts with Indian buyers would run from April to December, the sources said, rather than to March 22nd. It would assess the situation in over October and November before committing supplies for the first quarter of 2022, the sources said. The proposed change follows a decision by Iraq, OPEC's second biggest producer, to cut its oil exports to India this year to comply with Apex quotas. The proposed change follows a decision by Iraq, very important. So when it comes to the next segment, that is 10-year yield, what happens in the market, US Treasuries? Market expectations for US inflation rates have reached their highest levels in a decade, driven by prospects of a large fiscal package, progress on vaccine rollouts, and pent-up consumer demand. The anticipated rise in inflation expectation was something of a red herring when faced with economic realities. The yield on the benchmark US 10-year Treasury notes climbed above the 1.3% for the first time since February 2020, while the 30-year bond also hit the highest level for a year. 30-year also hit highest. And when it comes to German, let's look at the euro. German 10-year bond hit the highest level since June on Tuesday, as the expectation for the economic recovery and extraordinary fiscal stimulus in the United States pushed yields high across the board. German 10-year yield hit the highest level since June last year, rising 3 basis points to minus 0.353%. That's interesting, isn't it? Now let's look at the reflation trade. It's a prospect of a return to global growth after the economic hit from the COVID-19 pandemic. Ever since several drug makers in November revealed the strong efficacy results of their vaccines, investors are piled into assets that's winning an improving economic cycle. Ultra loose central bank monetary policies and hope more stimulus. They need to have more stimulus spending, and President Joe Biden has only given more fuel to these bets. Reflationary trades tend to involve assets exposed to faster economic growth, price pressures, and higher yields. Riskier equities tend to benefit the expected expenses of nominal bonds or those not protected against inflation. So that will have reflationary trades. That includes assets exposed for faster economic growth. In the stock market, it's small caps and cyclical sectors such as banks and energy producers which will do well. We have a reflection we have already seen. This time it also includes cruise operators, holiday makers, airlines, and other travel and leisure companies that benefit from an end to lockdowns. So those are a very important reflation trade. It is the go trade when economic sense, that is, economies emerged from a recession. It's a go-to trade model. In 2009, I can recall when growth was near through during the global financial crisis, small caps and value stocks had a moment in the sun. That is, they were booming. Since then, however, reflation trades have lost steam as rates of inflation and economic growth remain stubbornly low. You need a rebound in the market space. President Biden on Tuesday night pitched his $1.9 trillion coronavirus relief plan at a CNN town hall event in Wisconsin. So a reflection trade can give opportunities in the market space now. When it comes to important segment, oil prices, today WTI is $61 per barrel. Brent almost 65. Natural gas 3.25 MMBTU. WTI oil price have fallen, only for a short focus below 60, but remains steady from there on and it's bouncing back now to 60 plus. We are not seen since January 2020. So tremendous amount of excitement in terms of fluctuation. The financial markets are now highly volatile. The treasury rates will have consequential impact in the debt market, and it's all contingent on the expectation America will have vaccination drive in acceleration. We also have expectation the new incentives, money in the hands of average American will inflate the consumer spending and inflate the overall economy. So that's what the expectation is all about. These are all playing and is interconnected in the rest of the world. So it's a huge opportunity to look at encashment of the trading volumes. Ups and downs are always opportunity to buy or sell. Nothing is certain. That's the level of imperfection we are seeing in real order.